Is it okay to fund cash credit or overdraft facility to substitute these sundry creditors? Yes, often you will come across customers who are requesting for CC or OD facility with the reason that they have lot many sundry creditors and they want to substitute those sundry creditors with cash credit or overdraft facility. And this will generally happen in case of new business. Let's say new business generally say for first 1 to 3 years they'll not get much of bank finance. So how they'll be building up their balance sheet, how they'll be building up their current assets, obviously with the support of current liability, and main current liability will be sundry creditors. Let's say 100 million is their current asset, at least some 60 to 70 million they'll be dependent on sundry creditors fund, supplies credit. Okay. Now the question is whether banks can substitute this current liability with its CC or OD, because it looks like a good business opportunity, right? And for this customer also it is good because he is now dependent on more structured finance from a financial institution with a reasonable cost in the form of a CC or OD. So how to approach this, how to handle this, that's what we are going to see now. Now, if the customer is already dependent on sundry creditors for funding the current assets, you have to see what is the level. Because current asset can be funded by sundry creditors, it can be funded by bank finance through CCOD, then balance can be funded by net working capital. You have to see to what extent it is dependent. Let's say current asset is 100, sundry creditors is in the range of 70, meaning the remaining 30 is met out of net working capital. Then in this case, if you look at, this actually gives an opportunity for the bank, because for building up this current asset of 100, they have already, that is the firm or the promoters have already introduced the long-term fund in the form of net working capital to the extent of 30%. It means remaining 70% they are availing this market credit. And if you look at NRJca committee method, if you look at tandem committee method, everywhere the focus is like 25% of the current assets should be funded by the borrower entity through long-term funds, 25%. And here it is in the range of 30%. It means the remaining space can be funded in combination by banks, it can be funded by sundry creditors, and there is a space available. So if the borrower approaches to replace sundry creditors with bank finance, in this situation it is a go ahead situation, because bank is also getting a good opportunity. Think of another scenario where current asset is 100 and the current liability is say something like 120, and these current liabilities have become a problem for this customer. These current liabilities have become problem for this customers. They are charging high penal charges. They are also not ready to give credit. There is minimal credit, but this customer is delaying the payment. So all these are signs of strain being suffered by this unit, right? Because for building current asset of just 100 million, they have raised short-term funds, let's say from supplier itself, to the extent of 120 million, and that has not been used for properly creating the current assets, right? It means some money they have diverted for creating some long-term assets. So here, even though this business provides an opportunity to the bankers to fund so that they can get rid of this high cost fund, what we have to understand is this unit is already in a trouble. Because For settling this 120 million, they have resources of only 100 million. It means they have high level of liquidity strain. High level of liquidity strain. So, in these scenarios, as a banker, if you step in, what will happen is you actually relieve these suppliers. So, suppliers will get a safe bet and they'll leave and you will get into trouble. Okay. So, is it okay to fund CC? Is it okay to fund CC or OD for substituting sundry creditors? The answer is scenario like this, yes, good. Scenario like this is not that good. It's actually bad situation and you are actually going and putting yourself in trouble. Okay. So do that analysis and take a decision.
Thank you so much. We have come to the end of this webinar and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599 and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.
The link of the course I have given in the next lecture. So once you complete this video, just move on to the next lecture. You will find the link. Click enroll. I'll see you inside the course.